Hello and welcome to this session in which we would learn about the US tax history. You might be asking yourself, why do I need to learn about the US tax history in my income tax course? Well, it's very important to put things into perspective. In order to understand the tax law today, you need to understand where it derives from. From a historical perspective, how did we end up where we end up today? How did it all started? So it's very important and very beneficial to look at US tax history. What I'm going to do is break the tax history lesson into various periods and discuss each period separately, starting with the colonial times through the American Revolution. Then we would look at the 19th century, the Civil War, early 20th century, World War II, post-World War II era, and would look at major law changes that took place by various administrations, and we would look briefly at the 21st century where we are today. Let's go ahead and get started by looking at the colonial times through the American Revolution. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Well, obviously, the colonial time and the American Revolution is what? It's known by taxation without representation. And this is basically what led to the Independence War, because citizens were unhappy with the taxes imposed by them by the British. And this is what happened. These actions stoked the colonial discontent leading up to the Revolution War, which basically where the US gained independence. After the US gained independence, the federal government relied primarily on tariff. And what is tariff? Tariff is the tax imposed on product that you buy from another country. So if you want to buy stuff from Europe, from Mexico, from Canada, the government will impose tax on you. And this is how the government financed their operation. And also they levied taxes and excise tax, basically fee taxes, specifically like taxes on whiskey, for example, and this has led to something called the Whiskey Rebellion, basically because people don't like the taxes in 1794. In the 19th century here, we have to talk about the Civil War, obviously, but during the 1800s, the government largely financed itself through tariffs. This is what was the main source of revenue. However, during the Civil War, the North and the South, they both introduced an income tax system in 1861. So this is basically the first US income tax system. But this system was temporary only to finance the war. And indeed, it was repealed in 1872, which, yes, we had a tax system. The citizens were promised that once we paid off the war, the government says, that's it, we will repeal it. Indeed, they repealed it. In 1894, a new federal individual income tax system was enacted, but it was found to be unconstitutional. And there's a famous court case, Pollock v. Farmers, Loans and Trust. Here the Supreme Court decided whether the income tax is constitutional or not. Well, it was found to be unconstitutional. What was the case here? What was the issue? Why was it found unconstitutional? The US Supreme Court had to decide whether a tax on income from property, not property, income on property like land or personal belonging, was the same as the direct tax on the property itself. Why is this important? Because the US Constitution, Article 1, Section 8, states that certain type of taxes called direct taxes must be divided up among various states based on their population. So it has to be apportioned, proportional. So what they said is this: now you are taking more taxes from us, from income, from property, and that violated, now we're paying more because we have more income. You violated Article 1, Section 8. The court decided that the taxing income was unconstitutional, just like taxing the property itself, and citizens were paying more in proportion to relative to the population in that state. So, such a tax would be a direct tax and must be split among the states according to their population. Therefore, income tax was repealed. 20th century, starting with 1909, it was the first federal income corporate tax. So notice not individual, corporate. So how did the government package this tax? Rather than income, like an income tax, the one that was repealed, they packaged it as an excise tax, basically a franchise fee, a fee to be a corporation. This is how it was introduced. Basically, the right to do business in the corporate form. So it's a tax, but it's not really income tax. It's a franchise tax. Now, in 1913, well, the government needed money. What they did, now they ratified the Constitution. They amended the Constitution, the 16th Amendment, and now the government is permitted, according to the Constitution, to do what? Permit both federal, individual income tax and corporate income tax. So basically now they put this information in the Constitution. Now it cannot be challenged like what Pollock did earlier and challenge the income tax ability. Now we have what we call the federal income tax that we know about today. And the first 1040 was due March 1st, 1914. So notice it was started in 1913. The first 1040, the first income tax form was what the due date was March 1st, 1914. The personal exemption was $3,000 for single and $4,000 for married filing jointly. Basically, it wiped out most of the people. They could not pay taxes because they were exempt. Only the wealthy were affected, and the tax rate ranged from 1% to 6%. And obviously, the 6% was for people who had excess income of $500,000, which is very, very few people at that time. So this is the beginning of the income tax course that we know about. Then here comes post-depression, which is the Franklin D. Roosevelt New Deal, FDR New Deal. The rate prior to the New Deal, the top marginal income tax rate was 25%. What happened by 1936 under the New Deal initiative? The New Deal created more government program to help people get out of the depression. The income tax rate soared to 79% for people over $5 million in income. Also, the New Deal introduced new taxes, again, because they were financing a lot of programs. Social Security was one of them. They imposed high taxes on corporation, and they imposed something called the Wealth Tax Act of 1935, simply to tax the wealthy. They introduced the Social Security tax. It was a tax and a program. So they started to collect Social Security from people, and we talk about Social Security tax in a separate recording because it's very important. The New Deal expanded the number of people who are required to pay income taxes. So it increased that base a little bit further than when the tax was introduced initially. But the New Deal offered many, many services. Here comes World War II. What did we need for World War II? We needed a lot of money to finance the war. So the war increased the tax base, the people who are paying, and the rate as well, how much they are paying. In 1939, before the war, under 6% of the population paid federal income tax. By 1945, by the end of the war, 74%, the majority of the people, 3/4 of the people, from 6% to 75%, now they're paying income taxes. Also, what's important in this period between 39 and 45, we introduced the Tax Payment Act, which was reintroduced. At some point, it was part of the income tax during the Civil War, then it was taken out. The Tax Payment Act now introduced the withholding of taxes. This is important because we still have this ongoing system until today. What's withholding of taxes? When you work for a company, the company becomes the government collector. So rather than you paying the government directly, when you work, your employer, the company that you work for, will withhold taxes from your paycheck, making it easier for the government to collect the taxes. It becomes the employer responsibility to withhold taxes. Now, if you're self-employed, you still have to submit your taxes separately, obviously. After the war, we're going to move to the Kennedy's administration. In the early 1960s, the U.S. faced economic stagnation. So what did Kennedy introduce? Said, let's stimulate the economy by reducing the taxes. So the top marginal rate in the early 1960s was around 91%. And that's scary. Think about it. At some point, you make $1 or you make $100. If you're in the top rate, you pay of that dollar, 91 goes to the U.S. government. So you keep 9% out of your money. So what happened is, under the Revenue Act of 1964, signed by Lyndon Johnson after JFK's assassination, of course, the top rate was cut to 70% because JFK was assassinated before he implemented his deal. And the lower bracket also saw reduction. So overall, the we had a reduction in the tax rate to stimulate the economy. JFK believed in the theory that reducing tax rate would spur the economic growth and potentially increase overall tax revenue due to increased business activity. Now, I don't want to get political here, but obviously JFK is Democrat. That's not what they usually propose. Democrat on the other side, they believe in more government program. Republican, they believe in cutting the taxes. So let's move on from the Kennedy's era to the President Reagan. And we have now the Economic Recovery Act of 1981. Once again, the background here is the US was experiencing high inflation, high unemployment, and slow economic growth. What did President Reagan did? Well, cut tax brackets across the board by 23% over a 3-year period. So the top rate was slashed from 70, remember, went down to 70 during Kennedy's, but down to 50. And the lowest rate dropped from 14 to 11. So people at the lowest also paid less, lowest tax bracket. Then in 1986, we had the Tax Reform Act, which has simplified the tax code. It reduced the number of tax bracket, lowered highest individual income tax rate to 28%, the lowest has been since the 1920s. And simultaneously, it raised the bottom rate to 15. Again, went from 11 back to 15. And it eliminated certain deductions because we reduced the taxes. They eliminated the deduction for both corporations and individuals. So this way, the government can collect more money, and lower the corporate tax rate from 46 to 34. Overall, it simplified the tax rate. It lowered the taxes. What are the pros and the cons? The pros is the 1986 praised for simplifying the tax code. The tax code became simplified. So think about how complicated it was. It's still complicated now. Reduced high marginal tax rate, which many believe it spurred economic activity. Critics believe, well, it benefited the wealthy and contributed to the rising income inequality in the U.S. Because few years after this, the U.S. had the first major round of millionaires. They had much more millionaires after the 1986. Again, depending on what you believe. Do you believe lowering taxes will spur economic growth, or lowering taxes will benefit the rich? Those are the two arguments. Moving on, and we're going to see this theme again and again. In 2001, George W. Bush, Economic Growth and Tax Reconciliation Act of 2001. This was the major tax cut under President Bush. It was signed into law June 2001. The law created the new lowest tax bracket of 10% that we know about now for the first $6,000 of taxable income for singles and $12,000 for couples. Additionally, it gradually planned to reduce the tax rate over the years. By 2006, the top rate was decreased from almost 40% to 35%, and other rates were reduced as follow. 36 went down to 33, 31 to 28. Those are the different tax brackets. If you don't know what the tax brackets are, we'll talk about them soon. Simply put, if you were paying 28, now you pay 25. Also, the child tax credit went from 500 to 1,000. That was a big deal, basically doubling the child tax credit, and was made refundable. Refundable means even if you don't owe any taxes, we're going to give you the money if you have a child and you qualify. This act, again, there was another act in 2003 because the 2001 did not really do the job. And after 2001, after June, we had several events. One of them is obviously the September 11 attack, then the dot-com bust. Enron, WorldCom had to file for bankruptcy. The economy again went down. In 2003, President Bush signed another act, the Jobs and Growth Tax Relief Reconciliation, because the economy was slower. One of the most significant changes in this one was the qualified dividend and long-term capital gains that we need to learn about in this course that started in 2003, basically lowering individual income in the 10 and 15% tax bracket, and had a rate of 5%, which set to drop to 0% in 2008. Those, some of them are gone, but this is where we started to even lower the taxes further. Again, what's the goal? The goal is to accelerate the economy. Accelerating rate reduction, okay, planned for future years were implemented immediately. Remember, in 2001, they said they're going to plan to reduce it. In 2003, they immediately reduced them because they wanted to spur the economy. Again, what's the impact? Advocates, what would they say? They say that this stimulated economic growth, increased jobs, have helped alleviated the early 2000 recession from the dot-com. They also believe the cuts on dividend and capital growth would stimulate the investment. The critics, well, it disproportionately benefited the wealthy, so it benefited the wealthy more than the lower and middle class. and added significantly to the federal deficit. And this is where we started to grow deficit. Deficit means where the government is collecting less money than spending, and this is where the deficit started. After September 11, the deficit started to go up, and it has been going up since then. Let's move on to the Affordable Care Act, or known as the Obamacare. Known as the Obamacare included a range of revenue-raising provisions, and mainly the Obamacare is mainly concerned with health coverage, because President Obama wanted to solve this health crisis in the US, wanted to have more health coverage. They introduced few taxes. One of them is the net investment income. If you make more than $250,000 married filing jointly, you'll pay an additional 3.8% in taxes. The additional Medicare tax of 0.9, also if you make above a certain amount, I believe $250,000, you'll pay more in Medicare taxes. It added something called medical device excise tax. If you manufacture or buy medical devices from overseas, you pay 2.3% in excise tax. It even introduced something called the tanning tax. So if you have a tanning salon and you service people, there's a 10% excise tax, as well as other medical related taxes. Again, what is the goal? The goal is to increase the health coverage. So you need to raise money. So you introduce the Obamacare. Impact, it's played an essential role, this act, in funding the expansion of the healthcare coverage and the public health program. It also aimed at discouraging certain behavior that raise healthcare costs, smoking and other activities. Over time, several of these provisions faced opposition, especially during President Trump, and they were eventually modified or repealed. Let's move on to President Trump, which is the Tax Cuts and Jobs Act, and this is what you would learn in this course because it's going to be in effect until the year 2025. If it stays, hopefully it stays. I don't want to change my courses, right? Otherwise, it will go back to pre-2017. So it's from 2017 to 2025. It made several adjustments to the tax bracket. It lowered the tax bracket from 39.6 to 37. These are the changes in the tax bracket. It lowered the various tax bracket. Also kept the 10%, but now it applied to a different income level range. Other major provision of the Tax Act, which you will see in this course, it doubled the standard deduction, eliminated the personal exemption, capped the $10,000 deduction for the state and local income tax at $10,000. Even if you don't know what all these are, don't worry, you're going to cover each one of them separately in a separate session. But basically, it increased the deduction here, reduced the deduction here, reduced the deduction here, eliminated what's called a personal exemption. The child tax credit was doubled from $1,000 to $2,000 per child. And of that $2,000, $1,400 of it is refundable. It means you'll get your money. Also introduce a new credit called credit for other dependent, other than a child. From a corporate perspective, it brought the corporate tax rate to a flat 21% rather than a progressive tax rate. Also introduced what's called the qualified business income deduction, which is a deduction for pass-through entities like partnership as corporation. And don't worry, we'll learn about all these deductions in this course because this act is still in effect for our course, the course that you're going to be learning with us. What's the impact? Again, same story again and again. Advocates believe it stimulated the economy by reducing the tax burden on business and individual, leading to job creation and increased investment. Critics, again, it disproportionately benefited the wealthy, increasing the federal deficit. Of course, it increased the federal deficit, and potentially leading to future cuts in social program. Because if your deficit goes up, you cannot help. The government cannot intervene to help people. This is basically an overview. I'm not going to go into the Biden's era because it's still in process and we had COVID. We're not going to talk about this as well. So hopefully this kind of gives you an idea where the taxes started from and where we are today. Because as an accounting student, it's good to know the background, the context. Now we're going to learn about all these topics step by step in this course. What should you do now? Go to Farhat Lectures, complete some MCQs, true, false about this session. Study hard, good luck, and invest in yourself.